Welcome to everyone tuning in. Thank you for joining us today. My name is Jillian Perkins. I'm the Director of Communications at Arnerich Massena, a Portland-based investment advisory firm, bringing our unique and disciplined process and philosophy to high net worth individuals and families, nonprofit endowments and foundations, and corporate clients. Welcome to Part 1 of Investment Committees More Than the Sum of Their Parts. Today we're here to talk about nonprofit organization investment committees. Why is it that some investment committees generate better investment outcomes than others? Is it because they're better investors, or are there group dynamics at work that can systematically rob a committee of its ability to make strong decisions? Having worked with committees for more than 25 years, we wanted to share the knowledge that we've gained that can help investment committees function more effectively. So we recently published a white paper, Investment Committees More Than the Sum of Their Parts, which provides some strategies for committees to strengthen their decision-making and group processes, as well as address the pitfalls groups can fall prey to, in order to ultimately, hopefully, improve outcomes. Here to speak with us today are two contributors to the paper, senior consultants Chris Van Dyke and James Ellis. Both Chris and James have been working with investment committees for collectively more than 35 years and bring a wealth of experience in understanding what it is that makes committees successful, as well as what it is that can undermine them. So today, we get to pick their brains and learn more about what committees can do to become more effective and to improve their long-term results. So it's my great pleasure to introduce Chris and James.
Thank you, Jillian.
So I want to start just by getting a little bit of background on your work with investment committees. So Chris, can you start and tell us how long you've worked with investment committees, what types of committees, and in what capacities?
Yeah, so I've been working now for over 19 years, almost 20 years. And with respect to the committees I've worked with, it's been very much both for-profit, not-for-profit, endowments, foundations, private foundations, what have you. And so in terms of just experience, I think I bring to bear quite a bit of experience working in a number of capacities.
Mm-hmm. And James, the same thing. What is your history as it relates to working with investment committees?
Jillian, my experience has been over about 17 years. I've worked mostly with endowment and foundation type of clients, but I've also worked on the corporate side as well, discussing DC and DB plans. I've also been on the sales side where I've been, directly, pitching business to investment committees. So overall experience is about 17 years.
Mm-hmm. Great. So we have a lot of experience and knowledge in this room today. So let's dive in and talk about investment committees. So as we start, for the very beginning, looking at who goes onto an investment committee and how you make up a good investment committee that is going to be successful over the long term. Is there anything essential about the makeup of an investment committee, any particular background or experience among members that a committee needs to have in order to function well?
I'll start with this, if you don't mind, James.
Sure.
Overall, what I've seen in terms of just a very strong operational group, it tends to be with respect to very strong financial backgrounds as it relates to the goals and objectives you're seeking to achieve. This is from an investment committee standpoint. This doesn't necessarily drive down into the finance committees where you have more of an accounting role, etc. Finance committees are very much different. We won't talk too much about those today. It's more on the investment committee level. Mm-hmm. Investment committees, generally speaking, if you have a very good, diverse group of constituent individuals, that tends to help quite a bit.
Mm-hmm.
Yeah, absolutely. And to further your thoughts, Chris, having some institutional acumen when it comes to portfolio management is always helpful. Mm-hmm. There's lots of successful business leaders in each community that make contributions and do end up on boards and investment committees in some capacity or another. And while these individuals are successful and have been able to drive success in terms of an operation, sometimes that doesn't necessarily translate into portfolio management experience at the institutional level.
Right.
So while those are important individuals to have on an investment committee, it should be a mix of somebody who has investment acumen as well as business leaders in the community as well.
What do you think is the best size for an investment committee? How many people?
Yeah, as far as that goes, Jillian, I'd say it should be an odd number. That way, if a vote does come down to there is a tiebreaker, I guess you could say, in the event there is a split vote. But I'd say, the smaller committees tend to function better. I've worked with a not-for-profit that had a very large committee on the order of about 40 people, and it was just very difficult to, get consensus. You're always having to rehash decisions. There's constantly new members coming and old members going. So bigger is not necessarily better. I'd say smaller is better, definitely under 12, but more like 5 to 7 is ideal.
40 people. Chris, what's the largest committee you've worked with?
Oh, investment committee size, I would say it's been no more than, I'd say, low teens.
Gotcha. Okay.
Between 11 and 13, I think, have been the most. And
Wow.
generally speaking, that just happens to be due to the amount of time one can actually allocate.
Right.
Because these are many instances, people that are not being paid, they're volunteer positions.
Yes.
And so just having a quorum in general requires a larger set of individuals to be on the committee. I would say those, if they're very much high participation level, I would agree with James, 5 to 7 makes the most sense.
Smaller. Would you rather see a committee where there's low turnover and a lot of longevity and tenure among the members, or is it better to have rotating in new and fresh committee members periodically or routinely?
I would generally say that the longer-term orientation serves the committees much better in terms of their ability to maintain a disciplined investment portfolio and process, which tends to provide a lot better results because you have institutional knowledge as to what got you where you're at today. I will say that that's a competing view with respect to perhaps those that are looking to raise capital, in so much as to bring individuals on investment committees to be engaged and be a part of that. So it's one of those balances that we have to strike. So as an investment advisor, we prefer obviously to have longevity, but we see other competing forces.
That makes sense.
Yeah, and I've noticed, Jillian, newer members tend to come on and want to get swayed by emotions, want to time the market, aren't as disciplined when it comes to investment policy as the longer tenured members are. So that's a little bit of an issue, staying with investment policy and keeping a long-term focus. So I'd say the longer-term members do have that institutional knowledge of past decisions, the active versus passive debate, why are these alternative investments in the portfolio? The longer tenured members tend to recall those discussions, whereas newer members, you kind of have to keep reinventing those discussions and rehashing past decisions.
That makes sense. Bringing people up to speed takes time. So when you're working with investment committees, and obviously they have to make decisions frequently, are there particular decision-making processes that work best? Is it usually a vote? How does that work when you are making the decisions?
Yeah, as far as that goes, Jillian, I've been on committees where there's one kind of central authoritarian leader of the investment committee, and everybody else just kind of falls into line. And other ones are more democratic in terms of their approach, where the votes are, discussed and, vetted out. So as far as that goes, I think the democratic committees, of course, would be more beneficial to the overall organization because, generally the authoritarian just kind of has his or her idea and everybody else kind of falls into line. So that can lead to, herd behavior, if you will.
Right. That makes sense. Speaking of authoritarian versus democratic, what do you hope for in an investment committee leader? And how does that affect the overall teamwork and effectiveness of the group?
I was going to suggest really the basic tenets of a strong leader are that they are able to take in a lot of input and provide a lot of inquiry to any process. And with that, you have a very good dialogue, a lot of buy-in with respect to both strategy and implementation.
Yeah.
And generally speaking, they maintain just a very steady, consistent flow with respect to how the various information is disseminated, how decisions are made, and how strategy is ultimately implemented. And so I would suggest that ultimately the best leaders tend to maintain a very disciplined structure to how the investment program is implemented and ultimately managed.
And it's also good to have a leader of the investment committee who can keep the committee on focus. Many times, you'll be in an investment committee and get what I call into the weeds. And it's good to have a leader. And my job as consultant is to try and get the committee out of the weeds. But it's good to have, the chairman of the investment committee on your side to help in that regard.
Absolutely. So for investment committee members, if you have a new investment committee member, or just in general for investment committee members, what information would you say is most essential for them to understand being on an investment committee?
Yeah, as far as that goes, Jillian, it's important for the new member to understand that it's typically a long-term focus when it comes to E&F type of clients. With corporate clients, with a DC or a DB plan, the discussion is a little bit different. But the new member should understand this is a long-term time horizon type of portfolio, and trying to time the market in the short term based on current news events or emotions is futile at best. New committee members should also understand that cash is very corrosive to an institutional portfolio with a long-term time horizon, and that cash is never going to be able to preserve real purchasing power in the portfolio, much less support a 5% spend rate. So a lot of new committee members are cash curious, if you will. So it's good to get that committee member out of the weeds of thinking about cash as a holding in the portfolio.
I found that very much the long-term focus is essential. If you were to open up with anything, you would suggest, well, long-term, what does that mean?
Right.
That's more than 10 years. That's perpetuity. That's lifetimes upon lifetimes, right?
Right.
And so from our perspective, you have to look at it and say, okay, well then, what else should I be looking at? And, well, the point is like we've been mentioning, is what got us here? Has it worked? Maintain this discipline and maintain just the strategy looking forward well beyond any short-term volatility.
Right.
We cannot time markets. That's the joke is, or the term is, that you have to get it right twice. You have to pick when it's going to happen, then you then have to pick when you're going to get back in terms of exiting and then re-entering the markets in terms of being able to access the capital markets. So from our perspective, that's a very difficult exercise, as James had alluded to, futility. And so from our perspective, it's just maintaining the course. Asset allocation does generate a vast proportion of one's return over the long run. And so let's just maintain that disciplined strategy.
Right. That makes sense. So here's the kind of the crux of the issue. What problems and issues do you see among investment committees? What do they need to watch out for, pitfalls, particularly when it comes to group dynamics and, as you mentioned, herd behavior?
Yeah, I tend to look at it, James, if you don't mind me going. It looks from the perspective of behavioral biases. There are plenty to be had, and we all have them, including even the strongest consultants. It's just a matter of understanding where those biases really lie and how one can do the best that they can to really nullify any of those effects, or at least build around them. And so the general points that I bring up, and I've done this with board education, with finance committee education, investment committee education, just comes around what are the biases that we generally have as humans. It's human nature to have them, and how do we necessarily work around them,
right?
To the full benefit of the not-for-profit, the investment portfolio, what have you. And so those can be anchoring, confirmation bias, etc. I know, James, you have a couple near and dear to your heart.
Yeah, absolutely. As far as the confirmation bias goes, whenever you terminate a manager or make a big shift in asset allocation, committee members tend to compare, the future performance to what would have happened in the past. So getting that confirmation bias is always something that's a little bit of a challenge to overcome. Chris, as you mentioned, the anchoring of the portfolio, if there is a large drawdown in the markets, sometimes committee members are anchored in terms of getting back to a certain dollar level. That can be a little, that could cause some confusion when it comes to making decisions in the heat of the moment. And there's also a little bit of overconfidence. Somebody may come in and, again, be successful, in their day-to-day life and think that success directly translates into, institutional portfolio management, which,
right.
Oftentimes isn't simply the case. There's also a certain amount of skepticism that committee members sometimes have of the consultant. They like to play stump the consultant, if you will, where they come up with questions that aren't really for the good of the order, but more meant to throw off the consultant. But that is part of the game. I understand that there is skepticism of an advisor coming in, making suggestions that may feel difficult to make, but that's our job. That's what we do, and that's what we live and breathe on a day-to-day basis.
I think the one thing I'd add is that there's a general view that establishing or maintaining maybe with what peers are doing, etc., or staying with the herd from a conventional standpoint is the predominant way to be successful. It's certainly a disciplined approach, no doubt, but it's just a matter of maintaining a long-term strategy. Will do much better than moving towards whatever peer has been doing best recently.
Right.
So there's that recency bias that tends to take place.
Yeah.
The other point I brought up and we've heard before is there's a general view, and this isn't with any clients that we necessarily work with, but we've seen it before in terms of just looking at through various RFPs and prospects. Why not succeed conventionally when you can maybe succeed more unconventionally, right?
Right.
Sure.
There's that whole view overall. So we see it from the standpoint of there are some opportunities. We bring those opportunities, and it's with a design with respect to the client.
So in another podcast, we'll take a deep dive on the difference between a discretionary consulting approach and a traditional consulting approach. But just at a high level, what are some of the benefits that you see of considering a discretionary engagement with your investment advisor?
Yeah, as far as that goes, Jillian, we are big fans of discretionary investment management, just because of the fact that committee members, they have their day-to-day lives. They, are involved in their personal lives as well, and so it does take a lot of effort in terms of the investment committee members getting up to speed for these quarterly meetings, and most of the times they do not. They don't review the materials beforehand. Now that maybe that's the exception more than the norm, but nonetheless, it does take a lot of time to get ready for the meetings, to look over 100 pages of material, and come in and add to the discussion. So it removes that burden from the investment committee members. It also removes a certain amount of burden from the administrative staff as well, implementing new ideas into the portfolio, processing trades, rebalancing, raising cash, things of that nature. So it's good from a time perspective. And Chris, you probably have some thoughts on the actual portfolio management where the rubber meets the road.
Yeah, absolutely. I think James hit it spot on. It's time.
Yeah.
If you can allocate a couple hours once a quarter to managing a large institutional portfolio, that seems like a very modest amount of time.
Yeah.
In fact, I would suggest you're shortchanging one's ability to really manage the investment portfolio. Now, in many instances, the counter to that would be while you are hiring managers to honestly take the day-to-day, we're looking at long-term strategy. And with that, I would then suggest that governance might be the best strategy and or responsibility. And so with governance then becomes more monitoring. And with monitoring then suggests that you should allow for discretion on the day-to-day, cash flows, cash needs, manager implementation, what have you. And that's where we tend to see the light really turn on for a lot of committees that have moved to discretion. They then bring on new committee members that then look back and say, wow, we actually used to do that with our time. How could we maintain a focus on long-term strategy when we're looking backwards at performance and monitoring and evaluation and trying to make very much more minor adjustments to a portfolio as opposed to the broad scheme, which is long-term objective of the benefit of that mission and or purpose of the investment portfolio.
Right. Let's the committee focus on the big picture.
Absolutely.
Yeah, definitely. And most investment committees generally accept the consultant's recommendations, so it just speeds up the time frame of idea generation from our research staff, and approval at our portfolio management committee to implementation into the client portfolios. That goes from 2 quarters potentially down to a week. So the ideas that we generate become implemented much quicker and in a more timely fashion.
Much more efficient. Any other advice for committees that you would like to offer out today?
Well, I would suggest, it really comes down to maintaining the most amount of collaboration and communication. The more offline discussions that take place in terms of maintaining just out of the normal course of the quarterly meeting cycle, the better the results will be, whether it be not only from the governance and monitoring perspective and long-term strategy perspective, but also just generally from where everyone is in terms of where they fall in when they all meet with respect to each quarterly meeting, meaning everyone's on the same page, they have the institutional background, and we're all working in the same spot from the same chapter in the book, so to speak.
Right.
And I think, final thoughts, Jillian, are, to get the most out of your advisory relationship is to keep a long-term time horizon, let the experts be experts, and, don't hold cash as a position in the portfolio.
Wonderful. Well, I really appreciate both of you sharing your insights and your advice, and I think our audience will too. You've provided some really helpful practical solutions for improving investment committee structures and decision-making processes. So I want to just say a huge thank you to both of you, Chris and James, for being here today. Look for part 2 of this podcast series coming soon, in which we will go deeper into traditional versus discretionary advisory services and how to choose a service model that best fits your needs. If you want to learn more and read our white paper, Investment Committees More Than the Sum of Their Parts, visit our website at arnerichmassena.com. And thank you so much for joining us today.
Thank you.
Thank you.
Thank you for listening to Arnerich Massena's podcast. Please see the podcast description for important copyright and disclaimer information.